Introduction. So you want to be an investor. Well, you're about to embark on a journey that, if done correctly, can lead to financial independence and stress-free retirement. Of course, you can't just blindly invest your money and hope for the best. You need to have a solid plan. That's where this book comes in. In the following pages, we'll cover the basics of investing, including what stocks, bonds, ETFs, index funds, and mutual funds are, and how they work. We'll also talk about risk tolerance, asset allocation, and diversification. By the end of this book, you'll have a good understanding of how to build a solid investment portfolio that will help you reach your financial goals. Investing can be a great way to grow your money, but it's not without risk. Before you start investing, it's crucial to do your research and understand the basics. That way, you can make informed decisions about where to invest your money. There are several distinct kinds of investments, each with its own set of risks and benefits. For example, if you're looking to invest, stocks are generally more volatile than bonds. However, they also have the potential to generate higher returns. Mutual funds can offer a diversified portfolio with professional management, but they also come with fees and expenses. Ultimately, the best investment is the one that meets your unique goals and objectives. The stock market can be a great way to earn a return on your investment, but it can also be volatile. This means that stock prices can rapidly go up and down, and it's not always easy to predict when this will happen. Market volatility can be caused by various factors, including political uncertainty, economic changes, and natural disasters. While it can be tempting to try to time the market and buy when prices are low and sell when they're high, this is often easier said than done. For most people, it's best to remain invested for the long term and ride out the ups and downs of the market. Being prepared will help you weather any storms that come your way. By doing your homework and making smart choices, you can master investing and reap the rewards for years. While there's no guarantee of success, well-informed investors are more likely to reach their financial goals. Chapter 1. Stocks. When it comes to investing, there are a lot of options out there. You can invest in bonds, real estate, mutual funds, and more. But one of the most popular options is stocks. Stocks are a type of security that represents ownership in a company. When you buy a stock, you're buying a piece of the company. Owning stocks comes with a lot of benefits. For one, you can make money in two ways. First, you can make money through dividends. This is when the company pays you a portion of its profits. Second, you can make money when you sell your stocks for more than you initially paid for them. This is called capital gains. Another benefit of owning stock is that it gives you a say in how the company is run. As a shareholder, you have the right to vote on important company decisions, such as who sits on the board of directors. This chapter will provide a more in-depth look at stocks. It will discuss what they are, how they work, and the different types of stocks. It'll include information on how to buy and sell stocks and pick the right ones for your portfolio. Stocks. What they are. Now that we've looked at some of the benefits of owning stock, let's take a closer look at what stocks are. When people talk about the stock market, they are usually referring to the buying and selling of shares in public companies. When you buy a share in a company, you become a part owner of that business. As the company grows and becomes more profitable, the value of your shares will typically increase. Many people choose to invest in stocks because they offer the potential for high returns. However, stocks can also be risky, and their value can fluctuate wildly. Before investing, it is crucial to do your research to properly assess the risks involved. How stocks work. When a company wants to raise money, one of the options it has is to issue stock. This is when the company sells shares of ownership to the public. The money raised through this process can finance expansion, pay off debts, or other purposes. Issuing stock is a way for companies to raise money without taking on debt. Once a company has issued stock, it will trade on a stock exchange. The two most popular exchanges in the United States are the New York Stock Exchange, NYSE, and the NASDAQ. These exchanges are where buyers and sellers come together to trade stocks. When you buy a stock, you buy a company's shares from another investor. The price of the stock will be determined by the supply and demand for that particular stock. If there are more buyers than sellers, the price of the stock will go up. If there are more sellers than buyers, the price will go down. With stocks, you can make money in two ways: through dividends and capital gains. Dividends are payments that a company makes to its shareholders. These payments are typically made quarterly and are a portion of the company's profits. When you own stock in a company that pays dividends, you will receive these payments as long as you continue to own the stock. Capital gains occur when you sell your shares for more than you paid for them. For example, let's say you buy a share of a stock for $100. If the stock increases in value and you sell it for $120, you've made a capital gain of $20. Capital gains can be realized through stock price appreciation or dividends. Different types of stocks. Stocks come in several different forms, and each has its own set of characteristics. While there are many types of stocks, the two most common are common stock and preferred stock. There are also different classes of stock, such as Class A and Class B. Now that we've looked at how stocks work, let's take a look at the different types of stocks you can buy. 1. Common stock. Common stock is one of the most popular types of investments. When you buy common stock, you become a partial owner of a corporation. As an owner, you have certain rights, including the right to vote on corporate governance matters and to receive dividends. Unlike preferred shareholders, common shareholders do not have a guaranteed minimum dividend. However, common shareholders typically receive greater upside potential in the form of capital gains. When a company's stock price goes up, common shareholders can realize significant profits. For these reasons, common stock is an attractive investment for many people. 2. Preferred stock. Preferred stock is a type of investment that offers some key benefits for companies and investors. For companies, issuing preferred stock can be a way to raise capital without incurring debt. For investors, the preferred stock typically pays higher dividends than common stock and has priority in the event of a liquidation. In addition, preferred shareholders typically have voting rights in corporate matters. As a result, preferred stock can be an attractive option for both companies and investors. 3. Treasury stock. Treasury stock is a term used to describe the shares that have been repurchased by the company itself and are held in its treasury. These shares were originally issued to the public, but they have since been bought back by the company. Treasury stock does not give the holder any voting rights or dividend payments, but it does represent partial ownership of the company. When a company repurchases its shares, it reduces the number of outstanding shares on the market, which can help increase the stock price. In addition, holding treasury stock gives the company the flexibility to issue new shares in the future if needed. As a result, treasury stock can be an important part of a company's long-term strategy. 4. Penny stocks. When it comes to investing, there are a lot of options out there. Some people prefer to put their money into stocks, while others choose bonds or mutual funds. But for those who are looking for a higher risk-reward investment, penny stocks may be the way to go. Penny stocks are stocks that are traded for less than $5 per share. These stocks are usually not listed on major exchanges, which means they can be more volatile and harder to sell. For these reasons, penny stocks are often considered to be a high-risk investment. Penny stocks can also offer the potential for large profits if the company's stock price increases. For example, if a company's stock is trading at 50 cents per share and it doubles to $1, the investor's profit will be 100%. Before investing in penny stocks, do your research and understand the risks involved. Penny stocks can be a risky investment, but they also have the potential to provide big rewards. 5. Blue chip stocks. Blue chip stocks are the shares of large, established, and financially stable companies. They are often household names and have been in business for many years. They are considered to be a safe investment as these companies are typically less affected by economic downturns. For example, during the 2008 financial crisis, blue chip stocks lost an average of only 37%, compared to the overall market, which declined by 56%. While they may not offer the same potential for growth as other types of stocks, blue chip stocks tend to be less volatile and provide a steadier stream of dividend income. As a result, they can be a good choice for investors looking for a stable income. 6. Growth stocks. Many people feel that the best stocks to buy are growth stocks. These are stocks that are expected to experience above average price appreciation due to strong fundamentals. This can include companies with high levels of profitability, fast-growing revenue, and/or market-leading products or services. While there is no guarantee that a growth stock will continue to outperform the market, many investors feel that these stocks offer the best chance for capital appreciation. As a result, growth stocks are often some of the most popular investments. 7. Value stocks. Value stocks are a type of stock that represents a company that is considered to be underpriced by the market. They are usually PE stocks, meaning they have a low price-to-earnings ratio. This means that the market has not yet discovered the company's true value and is not pricing the stock accordingly. As a result, value stocks tend to be much cheaper than growth stocks. Value investors believe that the market will eventually realize the company's true value and the stock price will go up. For this reason, value investing is often considered to be a long-term investment strategy. Many of the world's most successful investors, such as Warren Buffett, have made their fortune by investing in value stocks. 8. Dividend stocks. For many investors, dividend stocks are an attractive option. They offer the potential for both income and capital appreciation, and they can provide a steadier stream of returns than some other types of investments. However, there are also some risks to consider before investing in dividend stocks. For one thing, they tend to be more volatile than other types of stocks, so their prices can fluctuate widely in response to changes in the market. Additionally, dividend stocks are often less liquid than other types of investments, so it may be difficult to sell them when you need to raise cash. But for patient investors who are willing to ride out the ups and downs, dividend stocks can offer a unique combination of risk and reward. How to buy and sell stocks. Buying and selling stocks can be a great way to make money, but there is always risk involved. Before making any decisions, be sure to do your research and speak with a financial advisor to get expert guidance. If you're thinking about buying and selling stocks, there are a few things you need to know first. Number 1. Stockbrokers. The first thing you need to do is find a reputable broker. This is someone who buys and sells stocks on your behalf. They will usually charge a commission for their services, so shopping around and comparing fees before choosing one is important. Once you've found the one you're comfortable with, you'll need to open an account with them. This is where you'll deposit your money and make your trades. When you're ready to buy stocks, it's important to do your research first. You should look at factors like a company's financial stability, its business model, and its competitive advantage. Once you've something you're interested in, you'll need to place an order with your broker. They will then execute the trade on your behalf. Once you own stocks, you can hold on to them for as long as you want or sell them at any time. If you decide to sell, your broker will execute the trade and transfer the money into your account. Remember, when it comes to stocks, timing is everything. So if you think a stock is going to go up in value, it's important to act quickly. On the other hand, if you think a stock is going to go down in value, it's best to sell before it does. 2. Online trading platforms. There are several options available when it comes to buying and selling stocks. For many people, the most convenient option is to use an online trading platform. These platforms allow investors to buy and sell stocks quickly and easily without the need to visit an actual broker. In addition, they typically offer a wide range of features, including real-time quotes, charting tools, and research resources. For these reasons, online trading platforms are a great option for anyone interested in buying or selling stocks. However, it is vital to choose a reputable platform with low fees. Many different online trading platforms are available, so it is important to compare options before making a decision. With a little research, you can find a platform that meets your needs and helps you make profitable investments. 3. Direct stock purchase plans. The stock market can be confusing and overwhelming, especially for beginners. But with some research and guidance, you can start investing confidently. One option for buying stocks is to participate in a direct stock purchase plan, DSPP. Many companies offer DSPs as a way for investors to purchase shares directly from the company without going through a broker. This can often be done at a discount to the market price. To participate in a DSPP, you will need to set up an account with the company and provide some basic information, such as your name, address, and social security number. Once your account is set up, you can begin buying shares. Most DSPs allow you to make regular purchases as well as one-time purchases. When you want to sell your shares, you can typically do so through the same account. While DSPs can be a good option for buying stocks, it's more important to do your research before setting up an account. Make sure you understand the fees involved and the minimum investment required. You should also consider whether the company's stock is a good investment for your portfolio. With a little knowledge and research, you can confidently start investing in the stock market. 4. Stock exchanges. One way to buy or sell stocks is through a stock exchange. A stock exchange is an organized market where stocks and other securities are traded between investors. There are several major stock exchanges around the world, such as the New York Stock Exchange, NYSE, and the NASDAQ. You'll need to use a broker when you buy or sell stocks through a stock exchange. You can either use a full-service broker who will provide guidance and advice on which stocks to buy and sell, or a discount broker who will simply execute your trades without giving any advice. Each option has its own set of pros and cons, so it's important to do your research before choosing one. Once you've decided on a broker, you'll need to open an account with them and deposit some money. Then you'll be able to start buying and selling stocks. How to pick the right stocks for your portfolio. One of the most important aspects of investing is choosing the right stocks for your portfolio. While there are many factors to consider, one of the most important is picking stocks that have the potential to provide long-term growth. While it can be tempting to choose stocks that are currently doing well, remember that past performance is no guarantee of future results. Instead, look for companies with a history of consistent growth and a strong future outlook. Additionally, diversifying your portfolio by investing in different industries can help mitigate risk. By carefully choosing the right stocks for your portfolio, you can give yourself the best chance of achieving success in the stock market. 1. Consider your investment goals. When it comes time to picking stocks, there's no one-size-fits-all approach. The best stocks for your portfolio will depend on your investment goals. Are you looking to grow your wealth over the long term? Are you saving for retirement? Or are you hoping to make a quick profit? Your answers to these questions will help you determine what kinds of stocks to look for. For example, if you're interested in long-term growth, you might want to focus on companies with strong fundamentals and a history of consistent profitability. If you're more interested in generating income, you might look for stocks that pay high dividends. And if you're looking to make a quick profit, you might focus on stocks that are undervalued by the market. By considering your investment goals, you can narrow down the universe of potential investments and choose the best stocks for your portfolio. 2. Determine your risk tolerance. One of the most important considerations is your risk tolerance. How much risk are you willing to take? Evaluating your risk tolerance is essential for picking the right stocks for your portfolio. There are several ways to determine it. One common method is to consider how you would feel if your investments lost value in the short term. If the thought of seeing your portfolio lose value makes you anxious, then you have a low risk tolerance. On the other hand, if you're comfortable with the idea of volatility and can stomach the ups and downs of the market, then you have higher risk tolerance. Another way to determine your risk tolerance is to think about how much of your portfolio you're willing to see fluctuate. If you're only comfortable with a small margin of volatility, then you have a low risk tolerance. However, if you're willing to see a larger portion of your portfolio fluctuate, then you have higher risk tolerance. Once you've determined your risk tolerance, you can start to pick the right stocks for your portfolio. If you have a low risk tolerance, then you may want to focus on blue chip stocks or index funds that offer stability and modest returns. If you have high risk tolerance, you may be more willing to invest in growth or speculative penny stocks. No matter what the level of tolerance is, it's important to remember that all investments come with some degree of risk. 3. Consider the company's financials. When it comes to investing in stocks, there are a lot of factors to consider. While paying attention to the overall market trends is important, it's also essential to do your homework on individual companies before buying any stock. One of the most important things to look at is a company's financials. This includes things like their revenue, expenses, and profit margins. By getting an idea of a company's financial health, you can better understand whether or not a stock is a good investment. Another thing to keep in mind is that company financials can change over time, so it's crucial to stay up to date on the latest financial reports. By doing your due diligence, you can ensure that you pick the right stocks for your portfolio. Stocks are a significant part of any investment portfolio, but with so many different types to choose from, it can be tough to know where to start. There are several factors to consider, including your risk tolerance and investment goals. Additionally, looking at a company's financials before buying any stock is crucial. By taking the time to do your research, you can make sure that you pick the right stocks for your portfolio. Chapter 2. Bonds. When it comes to investing, there are many different options to choose from. Stocks, mutual funds, and ETFs are all popular choices, but bonds should not be overlooked. Bonds are a type of debt investment, which means that you are lending money to a government or corporation in exchange for interest payments. Bond prices can fluctuate based on changes in interest rates, but they tend to be less volatile than stocks. Bonds can provide a measure of stability for your portfolio. In addition, bonds typically offer higher interest rates than savings accounts or CDs, making them an attractive option for income-oriented investors. If you're looking for a way to diversify your investments and generate steady income, bonds may be the right choice. In this chapter, we'll explain what bonds are, how they work, and the different types of bonds. We'll also provide information on how to buy and sell bonds and pick the right ones for your portfolio. Bonds, what they are and how they work. A bond is a debt instrument that pays interest and then returns the principal at maturity. Corporations and governments issue bonds to raise money for various projects and operations. When you buy a bond, you are effectively lending money to the issuer. In exchange for your loan, the issuer agrees to pay you periodic interest payments, known as coupons, and to return your principal when the bond matures. Bonds typically have a fixed maturity date, at which point the issuer repays the principal in full. The interest payments on a bond are determined by the coupon rate, which is set at the time of issuance. The coupon rate is the percentage of the bond's face value that you will receive in interest payments each year. For example, a bond with a face value of $1,000 and a coupon rate of 5% will pay you $50 in interest each year. The price of a bond can fluctuate based on changes in market conditions, but the coupon rate remains fixed for the life of the bond. This means that if interest rates rise, the price of your bond will fall because new bonds will be issued at a higher coupon rate. Conversely, if interest rates fall, the price of your bond will rise. While the price of a bond may fluctuate, the coupon payments are fixed. This makes bonds an attractive option for income-oriented investors who are looking for a predictable source of income. Types of bonds. There are many different types of bonds, each with its unique characteristics. The type of bond you choose will depend on your investment goals and objectives. Here are some of the most common types of bonds. 1. Corporate bonds. A corporate bond is a debt security issued by a corporation and sold to investors. The bonds are typically issued in multiples of $1,000, and each bond has a fixed interest rate and maturity date. When the bond matures, the corporation must pay back the principal plus interest to the bondholders. Corporate bonds are typically less risky than stocks, but they also offer lower returns. As a result, they are often considered to be a relatively safe investment. However, it is important to remember that there is always some risk involved in any investment, and corporate bonds are no exception. Before investing in any security, do your research and consult with a financial advisor. 2. Government bonds. Government bonds are debt securities issued by a national government to raise funds for various projects and initiatives. In most cases, the government will agree to repay the bondholder the principal plus interest at a set rate over some time. Government bonds are typically seen as low-risk investments since they are backed by the full faith and credit of the issuing government. Consequently, they tend to offer relatively low returns compared to other types of investments. Nevertheless, government bonds can be an important part of a diversified investment portfolio, and they can provide a measure of stability in times of market volatility. 3. Municipal bonds. Municipal bonds are debt securities that state and local governments issue to finance public projects such as roads, bridges, and schools. They are considered to be a safe investment because they are backed by the full faith and credit of the issuing government. Municipal bonds typically offer a higher interest rate than other types of investments, making them an attractive choice for investors who are looking for income. However, it is important to remember that municipal bonds are subject to market risk, so it is important to consult with a financial advisor before investing. 4. Savings bonds. Savings bonds are a great way to save money for the future. They are issued by the U.S. government and are backed by the full faith and credit of the U.S. government. Savings bonds are low-risk investments, and they earn interest over time. You can cash in savings bonds at any time, but if you cash them in before they reach maturity, you will forfeit some of the interest that is accrued. Savings bonds are a great way to save for retirement, education, or any other long-term goal. And because they are backed by the U.S. government, you can be confident that your investment is safe. 5. Treasury bonds. Treasury bonds are a type of government debt security, typically issued with a maturity of 10 years or more. The United States government bonds that the U.S. government issues are considered to be one of the safest investments accessible because they are backed by the full trust and credit of the United States government. Treasury bonds typically offer lower returns than other types of investments, but they also carry less risk. For this reason, they are often used as a way to preserve capital or hedge against inflation. Treasury bonds can be purchased directly from the government through its website, and they can also be traded on the secondary market. 6. Exchange-traded funds. Exchange-traded funds, or ETFs, offer investors a simple way to buy and sell bonds. ETFs trade on major exchanges like stocks, and they offer investors a variety of benefits. For example, ETFs are highly liquid, meaning that they can be bought and sold quickly and easily. They also offer greater transparency than traditional bond funds, since their holdings are disclosed daily. In addition, ETFs tend to have lower bond fees than traditional bond funds. As a result, ETFs offer investors an attractive option for buying and selling bonds. 7. Zero coupon bonds. When it comes to bonds, there are a lot of options out there. But if you're looking for a bond that offers a fixed rate of return and is relatively easy to purchase and sell, then you may want to consider a zero coupon bond. A zero coupon bond, sometimes known as an accrual bond, is a debt security that does not make interest payments regularly. Instead, the investor receives one lump sum payment at the maturity date. For example, Let's say you purchase a $1,000 zero-coupon bond with a 20-year term and an interest rate of 5%. When the bond matures in 20 years, you will receive $1,500, the original $1,000 investment, plus $500 in interest. Because zero-coupon bonds are issued at a discount to their face value, they offer investors the potential for higher returns than traditional bonds. However, they also come with some risks. For instance, if interest rates rise after you purchase a zero-coupon bond, you will not be able to sell it for as much as you paid for it. And if you need cash out of your investment before the maturity date, you will likely lose money on the deal. So before investing in any type of bond, including a zero-coupon bond, be sure to do your homework and understand the risks involved. How to buy and sell bonds. Bonds are a great way to invest your money. They offer stability and potential for growth and can be an excellent addition to any portfolio. Whether you're looking to buy or sell bonds, there are a few things you need to know. When buying bonds, it's crucial to research the issuer. You want to make sure that the company is stable and has a good credit rating. It's also important to pay attention to the interest rate on the bond. The higher the interest rate, the more you will earn in interest payments. Finally, you need to decide how long you want to hold the bond. Prices can fluctuate, so choosing a bond with a maturity date that meets your needs is vital. When selling bonds, you need to take into account the current market conditions. If interest rates have risen since you purchased the bond, it may be worth selling it to reinvest the proceeds at a higher rate. Alternatively, if interest rates have fallen, you may want to hold on to the bond until it matures so you can get the full value of your investment. Whatever you decide, it's essential to work with a reputable broker who can help you navigate the market and get the best price for your bond. When it comes to buying and selling bonds, you have a few different options. You can work with a broker, trade directly with another investor, or buy bonds through a mutual fund. Each option has its advantages and disadvantages, so it's crucial to consider your goals and objectives before making a decision. 1. Brokers. If you're looking for the simplest way to buy and sell bonds, working with a broker may be your best option. They have licensed professionals in the bond market. They can help you find the right bonds to meet your investment goals and provide guidance on timing and pricing. However, brokers typically charge commissions for their services, so factor this into your decision-making process. Remember that brokers work for themselves, not for you, so their interests may not always align with yours. Always do your research to ensure you're getting the best possible deal. 2. Online trading. Bonds are one of the most important investments that you can make. They provide stability and income during times of financial turmoil and can be a great way to diversify your portfolio. However, bonds can also be complex and confusing, making it difficult to know where to start. The good news is that you can now buy and sell bonds online without having to go through a broker. This means that you can trade bonds from the comfort of your home at the time that suits you. You can also access a wide range of information and resources that will help you make informed decisions about your investments. So if you're looking for a simple and convenient way to trade bonds, consider doing so online. 3. Bond funds. For centuries, people have looked to bonds as a way to preserve their wealth and generate income. Bond funds are managed by professional investors, and they offer a convenient way to diversify one's portfolio. When you invest in a bond fund, you are essentially pooling your money with other investors. This allows you to spread your risk and potentially earn higher returns than you would have by investing in individual bonds. Another advantage of bond funds is that they offer liquidity, meaning you can sell your shares at any time. However, bond funds also come with some risks. For example, if interest rates rise, the value of your investment may fall. Before investing in any type of security, it is important to understand the risks involved. With that said, bond funds can be a great way to add stability to your portfolio. How to pick the right bonds for your portfolio. When it comes to investing in bonds, there are a few things you need to take into account to pick the right ones for your portfolio. When deciding which bonds to invest in, it is crucial to consider the following factors to make the best decision for your portfolio. 1. Credit rating. When it comes to picking bonds for your investment portfolio, one of the key factors to consider is the credit rating of the bond issuer. A bond's credit rating is a measure of the issuer's ability to repay its debt obligations. The higher the rating, the lower the risk of default. Credit ratings are assigned by independent rating agencies such as Standard & Poor's and Moody's. One way to think about credit ratings is in terms of a risk spectrum. On one end of the spectrum are bonds with high credit ratings, which are considered to be relatively low-risk investments. These bonds tend to offer relatively low interest rates, but they also offer a higher degree of safety. On the other end of the spectrum are bonds with low credit ratings, which are considered to be high-risk investments. These bonds tend to offer higher interest rates, but they also come with a greater risk of default. In general, it is advisable to include both high and low credit bonds in your portfolio to diversify your risks. However, the precise mix will depend on your risk tolerance and investment goals. If you're investing for income, for example, you may be more willing to take on additional risk in exchange for higher interest payments. On the other hand, if you're investing for capital preservation, you may prefer to focus on bonds with higher credit ratings. Ultimately, it's crucial to do your research and make sure that you're comfortable with the level of risk inherent in any bond investment. 2. Maturity date. When it comes to investing in bonds, one of the most important considerations is the maturity date. This is the date on which the bond will reach its full value and can be cashed in for the principal amount plus any accrued interest. As a general rule, shorter-term bonds are less risky than their longer-term counterparts. This is because there is less time for market conditions to change, which leads to a loss of principal. However, shorter-term bonds also tend to offer lower interest rates, so it's important to strike a balance between risk and return when selecting bonds for your portfolio. For most investors, a mix of short and long-term bonds will provide the best combination of stability and growth potential. 3. Coupon rate. When it comes to bonds, the coupon rate is another important consideration. This is the interest rate the bond pays out, and it can greatly impact your overall return. For example, a bond with a higher coupon rate will generally offer a higher yield than a bond with a lower coupon rate. However, it's also essential to consider the other factors that can affect bond prices, such as inflation and the health of the economy. As a result, it's crucial to work with a financial advisor to ensure that you are selecting the right bonds for your portfolio. With careful planning, you can maximize your return while minimizing your risk. 4. Consider the tax implications. When it comes to picking the right bonds for your portfolio, there are a lot of factors to consider. One important factor is the tax implications of your investment. For example, if you're in a high tax bracket, you may want to consider municipal bonds, which are exempt from federal income tax. Alternatively, if you're in a lower tax bracket, you may want to consider taxable bonds, which offer a higher interest rate. Another vital factor to consider is the length of the bond term. Shorter-term bonds are less risky than longer-term ones, but they also offer lower interest rates. As a result, it's important to strike the right balance between risk and return when choosing the right bonds for your portfolio. 5. Decide whether to go it alone or use a professional. Deciding whether to go it alone or use a professional when picking the right bonds for your portfolio can be tricky. If you have a lot of money to invest, you may want to consider using a professional. They will be able to give you more individualized attention and advice. However, if you are working with a limited budget, you may want to go alone. Many resources are available online that can help you research types of bonds and find the ones that best fit your investment goals. Whichever route you choose, make sure to do your homework before making any decisions. Picking the right bonds for your portfolio is an important decision that should not be taken lightly. 6. Consider the risks. When it comes to investing in bonds, you need to think about your overall investment goals. Are you looking for income, stability, growth? Once you have a clear idea of your goals, you can start to narrow down your bond choices. For example, if you're looking for income, you might consider investing in government or corporate bonds. If you're looking for stability, you might want to consider investing in short-term bonds. And if you're looking for growth, you might consider investing in high-yield or international bonds. Of course, all bonds come with some level of risk. So before making any decisions, be sure to do your research and speak with a financial advisor. With a little bit of effort, you should be able to find the perfect bonds for your portfolio. 7. Set a goal and make a plan. When it comes to investing in bonds, the most important thing is to set a goal and make a plan. That may sound like common sense, but too often investors get caught up in the details and forget the big picture. Figure out what you're trying to achieve with your investment, and then develop a strategy for getting there. Do you want safety, income, or both? How long are you willing to tie up your money? What level of risk are you comfortable with? Once you've answered these questions, you'll be better positioned to pick the right bonds for your portfolio. 8. Review your progress regularly. When it comes to investing in bonds, there are many different factors to consider. Yields, maturities, and credit quality are just a few of the things that can impact bond prices. As a result, picking the right bonds for your portfolio can be a daunting task. However, by reviewing your progress regularly, you can make sure that your bond portfolio is on track to meet your long-term financial goals. Here are a few things to keep in mind when reviewing your bond portfolio. First, take a look at the performance of your bonds over time. Are they meeting your expectations? If not, why? Second, review your goals. Are you still on track to reach them? If not, it may be time to adjust your strategy. Finally, monitor the overall market conditions. This will help you identify any potential red flags that could impact the future performance of your bonds. By reviewing your bond portfolio regularly, you can make sure that it is aligned with your long-term financial goals. Bonds are an important part of any well-diversified portfolio, but picking the right bonds for your portfolio can be a challenging task. There are many different factors to consider. It's important to do your homework before making any decisions. However, by setting a goal and developing a plan, you can make sure that your bond portfolio is on track to meet your long-term financial goals. Reviewing your progress regularly will also help you stay on track and make any necessary adjustments along the way. You can find the perfect bonds for your portfolio with a little effort. Chapter 3. ETFs. For many people, the stock market can seem like a daunting place. With so many options and so much jargon, it's easy to feel like you're in over your head. However, there are some simple strategies that even beginner investors can use to get started. One of these is investing in exchange-traded funds, or ETFs. Whether you're just starting in the world of investing or looking to expand your portfolio, ETFs may be worth considering. This chapter will explain what ETFs are, how they work, and their different types. It'll also include information on how to buy and sell ETFs, as well as how to pick the right ones for your portfolio. ETFs. What they are and how they work. An exchange-traded fund, ETF, is a type of investment fund that holds a basket of assets, such as stocks or bonds. This diversification can help mitigate risk, as ETFs are less likely to be impacted by the performance of any one individual asset. Additionally, ETFs can be traded on major exchanges during regular market hours, making them a convenient and flexible investment option. Typically, an ETF will track a particular index, such as the S&P 500. This means that the fund's performance will mirror that of the index, providing investors with exposure to a broad range of stocks without having to purchase each one individually. ETFs can also be sector-specific, providing exposure to a particular industry or group of companies. For example, some ETFs focus on healthcare, technology, or even just US-based companies. The benefit of ETFs, diversification, flexibility, and liquidity, make them an attractive investment option for many people. However, it's important to remember that ETFs still come with risks. For example, if the market as a whole experiences a downturn, your investment will likely decline in value as well. When considering whether or not to invest in an ETF, it's important to do your research and understand the risks involved. Different types of ETFs. Now that you know a little bit about how ETFs work, let's take a look at the different types. 1. Equity ETFs. One type of investment that has become increasingly popular in recent years is equity ETFs. Equity ETFs are exchange-traded funds that track a specific index or sector. They can be a great way to diversify your portfolio and get exposure to a wide range of stocks. They are also relatively low cost and easy to trade. If you're looking for a way to invest in the stock market without having to pick individual stocks, equity ETFs may be a good option for you. 2. Bond ETFs. Investing in a bond ETF can be a great way to diversify your portfolio and earn a higher return than traditional bonds. Bond ETFs are exchange-traded funds that track a bond index, such as Barclays U.S. Aggregate Bond Index. They offer the same diversification benefits as traditional bond mutual funds, but with several advantages. First, they are more liquid, meaning you can buy and sell them more easily. Second, they are cheaper to trade than traditional bond mutual funds. Finally, they offer a higher yield than traditional bonds. For these reasons, investing in a bond ETF can greatly improve your portfolio's performance. 3. Commodity ETFs. Exchange-traded funds that track commodities have become increasingly popular in recent years as investors seek to diversify their portfolios and hedge against inflation. Commodity ETFs offer exposure to a wide variety of underlying assets, including metals, energy, and agricultural products. They can be traded on major exchanges throughout the world, and many ETFs offer 24-hour liquidity. In addition, commodity ETFs typically have lower expense ratios than traditional mutual funds. For all of these reasons, commodity ETFs have emerged as a popular tool for investors seeking exposure to the commodities markets. 4. Currency ETFs. Currency ETFs are exchange-traded funds that attempt to track the movements of specific currencies. They can be used as a tool for hedging against currency risk or for speculation. Currency ETFs are typically denominated in US dollars, but some also offer exposure to other currencies, such as the euro and Japanese yen. Currency ETFs are typically more volatile than traditional stock and bond ETFs and often have higher expense ratios. However, they can be a useful tool for investors who want to gain exposure to foreign currencies without the hassle of buying and selling individual currency pairs. 5. Inverse ETFs. A new type of ETF has been gaining popularity in recent years, known as an inverse ETF. As the name suggests, an inverse ETF is designed to move in the opposite direction of the underlying index or asset. For example, if the S&P 500 index declines by 1%, an inverse ETF tracking the index would rise by 1%. Inverse ETFs can be used to hedge against market declines or to profit from market weakness. However, inverse ETFs are not without risk. For example, if the market rallies unexpectedly, an inverse ETF could lose value. As such, inverse ETFs are best suited for experienced investors with a high tolerance for risk. 6. Leveraged ETFs. Leveraged ETFs are a type of exchange-traded fund that use leverage to achieve a higher return. Leveraged ETFs are designed to provide a return that is 2 times or 3 times the return of the underlying index or asset. For example, if the underlying index increased by 10%, then a 2 times leveraged ETF would increase by 20%. Leveraged ETFs can be a great way to boost your returns, but they also come with some risks. Because they use leverage, they are more volatile than non-leveraged ETFs. This means that you could potentially lose money if the market moves against you. For this reason, it's important to understand how leveraged ETFs work before investing in them. 7. Sector ETFs. If you're looking to invest in a particular sector of the economy, sector ETFs can be a great option. With sector ETFs, you can buy into an entire sector with just one purchase. This can be helpful if you want to target a specific industry or group of companies. For example, if you're bullish on the healthcare sector, you can purchase a healthcare sector ETF. These ETFs are also fairly liquid, so you can buy or sell them relatively easily. And because they're traded on the stock market, they can also offer some potential tax advantages. Sector ETFs can be a convenient and cost-effective way to invest in your favorite industries. 8. Thematic ETFs. For investors looking to take a more targeted approach to their portfolios, thematic exchange-traded funds, ETFs, offer an appealing option. These are funds that invest in companies that are expected to benefit from specific megatrends or themes. For instance, some ETFs focus on companies that are leaders in the fields of clean energy, healthcare, innovation, and the Internet of Things. While traditional ETFs tend to be broadly diversified, thematic ETFs can have a narrower focus, which can make them more volatile. However, for investors who do their research and choose carefully, thematic ETFs can offer the potential for greater returns. And with the range of themes available today, there's sure to be a thematic ETF that suits every investor's needs. 9. Smart beta ETFs. If you're like most people, you probably think of the stock market as a place where you buy stocks and hope they go up in value. But there's a lot more to it than that. For instance, there are different ways to buy stocks. And one of these is through something called a smart beta ETF. ETF stands for Exchange Traded Fund, and a smart beta ETF follows a rules-based indexing strategy. In other words, it doesn't just track the overall market or a particular sector, it tracks an index that has been specifically designated to outperform the market. And because smart beta ETFs seek to provide better returns than the overall market, they can be an attractive option for investors. 10. Fixed income ETFs. Exchange-traded funds, ETFs, have become increasingly popular in recent years, and for good reason. ETFs offer the benefits of both stocks and mutual funds, making them versatile options for investors. And with the vast array of ETFs now available, investors can easily find one that meets their unique needs. For example, fixed income ETFs offer exposure to the bond market without the hassle of individual bond ownership. These ETFs are particularly well suited for income-focused investors, as they offer a consistent stream of distributions. Moreover, fixed income ETFs are often more tax efficient than traditional bond portfolios. As a result, they can be an attractive option for investors looking to boost their portfolio's yield. Buying ETFs. Now that you know what ETFs are and how they work, you're probably wondering how to buy them. Fortunately, buying ETFs is a fairly straightforward process. They are traded on the stock market, so you can buy and sell them through a broker just like you would with stocks. And because ETFs are so popular, most major brokerages offer a wide selection of ETFs to choose from. 1. Opening a brokerage account. For many people, the thought of opening a brokerage account and buying ETFs can be daunting. After all, there's a lot of jargon to wade through, and it's easy to make mistakes that could cost you money. However, with a little research and planning, it's not as difficult as it may seem. The first step is to find a reputable broker that offers the types of ETFs you're interested in. Once you've opened an account, you'll need to fund it with cash or securities. Then you're ready to start buying ETFs. Most brokers will allow you to buy and sell online or over the phone. The key is to start slowly and build your position over time. With a little patience and discipline, you can be on your way to becoming an ETF investor. 2. Determining the right ETF for you. When it comes to investing ETFs, there are a lot of choices out there. With hundreds of different ones available, how do you know which one is right for you? The first step is to understand your investment goals. Are you looking for long-term growth, or are you more interested in immediate income? Once you have a clear idea of your goals, you can start to narrow down your options. For example, if you're looking for long-term growth potential, you might want to consider an ETF that tracks the S&P 500 index. On the other hand, if you're more interested in generating income, you might want to look at an ETF that focuses on high-dividend stocks. No matter what your goals are, there's an ETF out there that can help you achieve them. The key is doing your research and ensuring you're comfortable with the risks involved. 3. Buying process. Once you've found a few ETFs that you're interested in, it's time to start the buying process. The first step is to place an order for the ETF shares that you want to buy. Remember that they trade like stocks, so the price can fluctuate throughout the day. As such, monitoring the market and placing your order when the price is right for you is important. Following these steps should help you buy ETFs successfully. Just remember to do your research and always stay aware of the current market conditions before placing any orders. Selling ETFs. ETFs, like any other security, can be sold for various reasons. Perhaps you need to raise cash to cover a major expense, or maybe you're rebalancing your portfolio and selling some of your winners to buy other assets. Whatever the reason, it's crucial to understand the process before you sell. 1. Tax implications. When an ETF is sold, any capital gains or losses will be subject to taxation. Additionally, dividends paid out by an ETF may also be subject to taxation. As a result, it's important to consult with a tax advisor before investing to make sure you understand the potential tax implications. 2. Selling process. When it comes time to sell your ETFs, the process is quite simple. The first step is to find a buyer who is willing to pay the price you are asking for your shares. This can be done through a broker or directly through an exchange. Once you have found a buyer, the next step is to agree on a price and complete the sale. After the sale is complete, the funds will be transferred from your account to the buyer's account, and the transaction will be processed. In most cases, the entire process can be completed in just a few minutes. However, it is always important to check with your broker or exchange to make sure that everything goes smoothly. 3. Settlement. When you sell an ETF, the trade is settled just like any other stock transaction. The buyer pays the seller agreed upon price on the agreed upon date. The key difference is that because ETFs are traded on stock exchanges, the settlement process is settled between two parties through their brokerages. In addition, because ETFs are often sold in large blocks, the actual number of shares exchanged may be different from the number of shares you sell. This is because the market maker who handles your order may not have enough ETF shares to cover your entire order. When this happens, your order is partially filled, and you will receive a partial payment for your shares. However, you will still be obligated to deliver the full number of shares you sold, and you will receive a partial payment for your shares. However, you will still be obligated to deliver the full number of shares you sold. It's important to be aware of this potential difference between the number of shares you sell and the number of shares you deliver, as it can impact your tax liability come tax time. Picking the right ETF. There are a few things that you should keep in mind when picking an ETF. From your investment goals and risk tolerance to availability and fees, there are several factors to consider. Here are a few tips to help you pick the right one for your portfolio. 1. Consider your investment objective. When it comes to investing in ETFs, the options can seem overwhelming. However, by taking the time to consider your investment objectives, you can narrow down your choices and pick one that is right for you. For example, if you are looking for long-term growth potential, you might want to invest in an ETF that tracks a broad index, such as the S&P 500. On the other hand, if you are looking for income-producing investments, you might want to focus on ETFs that invest in bonds or dividend-paying stocks. By clearly defining your investment goals, you can make the process of picking an ETF much simpler. In addition, by working with a financial advisor, you can get help selecting one that fits your unique needs and circumstances. 2. Consider the fees. When you're looking to invest in an ETF, there are a lot of factors to consider. But one of the most important is fees. After all, you don't want to end up paying more in fees than you're making in profits. So how do you know which ETF is right for you? The first step is to understand the different types of fees that an ETF can charge. The most common are management fees, which are charged by the fund manager in exchange for their expertise. You'll also find ones that charge performance fees based on the fund's performance over a given period. And finally, some funds charge both management and performance fees. With all of these options, it's important to compare the fees before you decide which one to invest in. Not all ETFs are created equal, and the differences in fees can greatly impact your bottom line. 3. Consider the tracking error. One important metric is the tracking error, which measures how closely an ETF tracks its underlying index. A higher tracking error means that the ETF is deviating more from the index, which can be due to several factors, including fees, expenses, and market volatility. Tracking error is an important metric to consider when picking an ETF, as it can impact your investment returns. For example, if you're looking for an ETF that tracks the S&P 500, you'll want to choose one with a low tracking error. All else being equal, a lower tracking error means that you're more likely to see the same returns as the underlying index. Therefore, when considering which ETF to invest in, be sure to check the tracking error. 4. Understand the differences between indexes. Investors often turn to exchange-traded funds, ETFs, as a way to get exposure to a broad range of asset classes in a single investment. However, not all ETFs are created equal. One important distinction is between those that track the different types of indexes. For example, some ETFs track market capitalization weighted indexes, while others track equally weighted indexes. So what's the difference? Market capitalization weighted indexes are designed to give investors exposure to the largest and most influential companies in a given market. The index is weighted according to the market value of each company's outstanding shares. This means that the biggest companies have the biggest impact on the performance of the index. Equal weighted indexes, on the other hand, give each company in the index an equal weighting regardless of its size. This gives smaller companies a greater impact on the index's performance. As a result, equal weighted indexes tend to be more volatile than market capitalization weighted indexes. So which type of ETF is right for you? It depends on your investment goals and risk tolerance. A market capitalization weighted ETF may be a better choice if you're looking for stability and lower volatility. But if you're willing to take on more risk in exchange for the potential for higher returns, then an equal weighted ETF could be a better fit. 5. Consider the liquidity. Liquidity refers to how easy it is to buy and sell shares of an ETF. A highly liquid ETF will have a lot of buyers and sellers, and the prices will be close to the current market value. A less liquid ETF may have wider bid-ask spreads, meaning that you'll pay more to buy shares and receive less when you sell. It's crucial to consider liquidity when picking an ETF because it can greatly impact your ability to trade in and out of positions. If you need to sell shares quickly, a less liquid one may not be the best choice. However, if you're content to hold your position for longer, liquidity may not be as important of a consideration. Exchange-traded funds, ETFs, have become increasingly popular in recent years, and for a good reason. They offer a simple way to get exposure to a wide range of asset classes and can be a cost-effective way to build a diversified portfolio. However, not all ETFs are created equal. There are several considerations to take into account when picking an ETF, including fees, tracking error, index type, and liquidity. Each investor's situation is different, so there is no one-size-fits-all answer. However, by taking the time to understand your investment goals and risk tolerance, you can narrow down the choices and find the ones that are right for you. Chapter 4. Index Funds. If you're looking to invest in the stock market, one of the smartest things you can do is choose an index fund. An index fund is simply a mutual fund that tracks a stock market index. That might sound like a mouthful, but it's quite simple. By investing in one, you're essentially buying a piece of every company that makes up the index. And because you're diversified across so many different companies, you're less likely to experience major losses if one specific company takes a hit. Index funds are also amazingly affordable and offer a great way for beginner investors to get started in the stock market. So if you're looking to grow your money without taking on too much risk, index funds are worth considering. This chapter will explain everything you need to know about index funds, including how they work, and the different types available. We'll also cover how to buy and sell index funds, as well as how to pick the right one for your portfolio. Index funds: what they are and how they work. Many people think of the stock market as a risky investment, but there are several ways to minimize risk. One way to do this is through index funds. An index fund is a type of mutual fund that tracks the performance of a specific market index, such as the Dow Jones Industrial Average or the S&P 500. They are attractive to investors because they offer diversification and low expenses. Additionally, because index funds track an entire market rather than individual stocks, they tend to be less volatile than other types of investments. As a result, they can provide a great way for investors to participate in the stock market without taking on excessive risk. When you invest in an index fund, you are essentially buying a piece of every company that makes up the index. For example, if you invest in an S&P 500 index fund, you will own a small piece of every company in the S&P 500. This diversification is one of the main benefits of index funds, as it helps to protect your investment from losses in any one specific company. They are also very affordable, as they generally have lower expense ratios than other types of mutual funds. Another major benefit of index funds is that they are passive investments, which means that they require very little maintenance. Once you have invested in an index fund, you can simply let it grow and rebalance itself over time. There are a few different types of index funds available, which we will discuss in more detail below. The different types of index funds. There are several different types of index funds available, each of which tracks a different market index. If you're considering investing in an index fund, it's important to choose one that aligns with your investment goals. For example, if you're looking for a more aggressive investment, you might choose an index fund that tracks a broader market index, such as the S&P 500. On the other hand, if you're looking for a more conservative investment, you might choose an index fund that tracks a narrower market index, such as the Dow Jones Industrial Average. Some of the most popular index funds include: 1. Equity index funds. When it comes to investing, there are a lot of different strategies and products to choose from. One type of investment that has become increasingly popular in recent years is equity index funds. As the name suggests, these funds invest in a basket of stocks that track a particular index, such as the S&P 500. Equity index funds offer several benefits, including diversification, low expenses, and tax efficiency. And because they track an index, they tend to be more stable than actively managed funds. For all these reasons, equity index funds can be an attractive option for long-term investors. 2. Bond index funds. A bond index fund is a mutual fund that invests in bonds. The value of the fund goes up as the prices of the bonds in the fund rise, and vice versa. Bond index funds are often used by investors who want to diversify their portfolios and reduce risk. However, they can also be volatile, so it is important to do your research before investing. For example, if interest rates rise, the value of bond index funds will generally fall. But if you hold the fund for the long term, you will generally experience growth as the bonds in the fund mature and pay out dividends. So, if you want to diversify your portfolio and minimize risk, a bond index fund may be right for you. 3. Commodity index funds. Commodity index funds give investors exposure to a broad range of commodity markets, including energy, metals, and agricultural products. Index funds offer several benefits, including diversification, low expenses, and easy liquidity. Moreover, because they track an index, they provide a way to invest in commodities without having to pick individual winners. However, index funds also come with some risks, such as the potential for underperformance during periods of market turmoil. Nevertheless, for many investors, commodity index funds offer an attractive way to gain exposure to the commodity markets. 4. Balanced index funds. One of the simplest and most effective ways to invest is to put money into a balanced index fund. Index funds are mutual funds that track a specific market index, such as the S&P 500. A balanced index fund is a type of index fund that includes a mix of different asset classes, such as stocks, bonds, and cash. The benefits of investing in a balanced index fund include diversification, simplicity, and low fees. When you invest in a balanced index fund, you automatically own a piece of every company included in the fund. This diversification helps protect your investment from the ups and downs of any one particular company or sector. Moreover, because the fund is managed by professionals, you don't have to worry about making your own investment decisions. Finally, index funds typically have lower fees than other types of investments, such as actively managed mutual funds. For all these reasons, investing in a balanced index fund is an excellent way to grow your money over time. 5. Target date index funds. Target date index funds invest in a mix of stocks and bonds, and the proportion of each asset type is automatically adjusted over time based on the target retirement date. For example, someone with a target retirement date of 2025 would have a portfolio that is more heavily weighted towards stocks than someone with a target retirement date of 2035. This can be a great option for people who don't want to have to worry about constantly rebalancing their portfolio. Additionally, these funds typically have lower fees than other investment vehicles, which can add to significant savings over time. If you're looking for a hands-off approach to investing for retirement, target date index funds may be right for you. 6. Alternative index funds. Index funds are a popular choice for investors who want to minimize risk and maximize returns. However, traditional index funds may not be the best option for everyone. Alternative index funds can provide exposure to a wider range of asset classes, including commodities and real estate. In addition, alternative index funds often use complex strategies such as short selling and leverage to generate higher returns. While these strategies can lead to higher risks, they can also provide the potential for greater rewards. As a result, alternative index funds may be a good choice for investors who are willing to take on additional risk in pursuit of higher returns. 7. Hedge fund index funds. Hedge fund index funds are a type of investment fund that tracks the performance of a specific index, such as the S&P 500. These funds are typically managed by experienced professionals who use a variety of strategies to achieve their goals. For example, they may employ hedging techniques to protect against downside risk or take advantage of arbitrage opportunities. While hedge fund index funds can provide superior returns, they also come with higher fees and risks. As such, these funds are not suitable for everyone. Before investing in a hedge fund index fund, thoroughly research the fund and understand its objectives and risks. 8. Smart beta index funds. Many investors are now turning to smart beta index funds, which offer the potential for higher returns while still providing the diversification of a traditional index fund. Smart beta index funds use advanced statistical techniques to select stocks that are expected to outperform the market. For example, a fund might focus on companies with strong fundamentals or those that are undervalued by the market. By carefully selecting stocks, smart beta index funds aim to provide higher returns than traditional ones. In addition, these funds often have lower expenses than those that are actively managed, making them an attractive option for cost-conscious investors. 9. Actively managed index funds. Index funds are often lauded for their low expense ratios and passive investment strategy. However, there is another type of index fund known as an actively managed index fund. These funds seek to outperform the market index that they track by actively selecting and buying stocks. While they typically have higher expense ratios than their passive counterparts, they can offer investors the potential for higher returns. For investors looking to take a more hands-on approach to their index investing, actively managed index funds may be worth considering. 10. Synthetic index funds. Index funds come in two main varieties: traditional index funds and synthetic index funds. Traditional index funds simply invest in the securities that make up the underlying index. Synthetic index funds, on the other hand, use derivatives to replicate the performance of the underlying index. While both types of index funds have their benefits, synthetic index funds often come with higher risks. For this reason, it is important to carefully consider your investment goals before choosing an index fund. How to buy and sell index funds. When you buy an index fund, you're buying a share of all the stocks in that index, which makes them a great choice for diversification. They can be bought and sold just like any other type of mutual fund. You can do this through a broker or directly from the fund company. The process is simple. However, there are a few things to keep in mind when buying and selling index funds. First, it is essential to understand the fees associated with each transaction. Second, you need to be aware of the minimum investment requirements for each fund. Finally, you should familiarize yourself with the different types of index funds available so that you can choose the right one for your investment goals. By following these simple tips, you can make buying and selling index funds an easy and rewarding experience. Picking the right index fund for your portfolio. With so many different indexes to choose from, it can be tricky to pick the right one for your portfolio. One way to narrow down your options is to consider your investment goals. For example, if you're looking for long-term growth, you might want to invest in an index fund that tracks the S&P 500. On the other hand, if you're more interested in income generation, you might consider an index fund that tracks the Dow Jones Industrial Average. Another factor to consider is your risk tolerance. Index funds that track more volatile indexes may offer higher returns, but they also carry more risk. Ultimately, the best index fund for your portfolio depends on your individual investment goals and risk tolerance. Working with a financial advisor can help you make the best choice for your situation. Things to consider when buying and selling index funds. 1. Index tracking method. The S&P 500 index is one of the most popular indexes that people use to track the stock market. There are a few different methods that people use to track the S&P 500. The first method is called full replication. This involves buying all 500 stocks in the index in the same proportions as they are represented in the index. The second method is called sampling. This involves buying a smaller number of stocks chosen to represent the overall index. The third method is called synthetic replication. This involves using financial instruments like derivatives to get exposure to the index without actually buying any of the stocks. So when considering an index fund, it's vital to ask how the fund manager tracks the index. Otherwise, you could end up with a different kind of investment than you expected. 2. Funds holdings. Many first-time investors will believe that all index funds are the same. However, there are a few key things to look for when buying and selling index funds to get the most out of your investment. One important factor to consider is the fund's holdings. For example, an index fund that tracks the S&P 500 will have different holdings than an index fund that tracks the Dow Jones Industrial Average. Therefore, it is crucial to understand what you are buying before making a purchase. Additionally, it is also critical to consider fees and expenses. While most index funds have low fees, some funds can have high expense ratios, which can eat into your returns. Lastly, even though index funds are relatively safe investments, they still come with risks. Therefore, diversify your portfolio to mitigate risk. By following these tips, you can be sure to choose the right index fund for your investment goals. 3. Funds, fees, and performance. When it comes to investing in index funds, you'll want to consider the fees associated with the fund. While index funds typically have lower fees than actively managed funds, you can still eat into your returns if you're not careful. Similarly, you'll want to scrutinize the fund's performance. Even though index funds are designed to track the market, there will be some variation from one fund to the next. By doing your homework and selecting a fund with low fees and a history of strong performance, you can ensure that your index investing experience is a positive one. 4. Risk level. When it comes to investing in index funds, there are a few things you need to take into consideration, one of which is risk level. Index funds come with different levels of risk, so choose a fund that's suited to your investment goals and risk tolerance. For example, If you're looking for a long-term investment, you may be willing to accept a higher level of risk in exchange for the potential for higher returns. On the other hand, if you're looking for a short-term investment, you'll likely want to choose a fund with lower risk. In either case, it's important to do your research and understand the different types of index funds before making any decisions. By taking the time to understand your options, you can ensure that you make the best decision for your needs. Index funds are a type of mutual fund that tracks a specific market index. They offer several benefits, including low fees, diversification, and the potential for strong performance. However, it's essential to understand the different types of index funds and the risks involved before making any decisions. By taking the time to learn about index funds, you can be sure to choose the right one for your investment goals. Chapter 5. Mutual funds. There are many different types of investments, and each has its benefits and risks. One popular type of investment is a mutual fund. These funds allow investors to pool their money together and then have a professional manager invest it in various securities, such as stocks, bonds, and cash. This diversification can help to reduce risk, and professional management can provide the expertise that individual investors might not have. This chapter will provide an overview of mutual funds, including how they work, the different types available, and how to buy and sell them. It will also offer some tips on picking the right mutual fund for your investment goals. Mutual funds: what they are and how they work. A mutual fund is a type of investment that pools together money from many different investors and then uses it to buy a variety of assets. The most common type of mutual fund invests in stocks, but there are also bond funds, money market funds, and even real estate funds. Each mutual fund has a specific investment objective, which determines the types of assets that the fund will buy. For example, a growth fund typically invests in stocks of companies that are expected to experience above-average growth, while an income fund may invest in bonds and other income-producing securities. Mutual funds are managed by professional money managers, who make all of the decisions about what to buy and sell. When you invest in a mutual fund, you become a part owner of the fund and are entitled to a portion of the profits, or losses, generated by the fund's investments. Mutual funds offer several advantages, including professional management, diversification, and liquidity. However, they also have some disadvantages, such as fees and expenses. Before investing in a mutual fund, it is crucial to comprehend both the risks and rewards associated with this type of investment. Different types of mutual funds. Mutual funds come in wide varieties, so it's crucial to research to find one that matches your investment goals. For example, if you're looking for growth, you might want to invest in a stock mutual fund. If you're looking for income, you might want to invest in a bond mutual fund. And if you're looking for stability, you might want to invest in a money market mutual fund. No matter what your goals are, there's a mutual fund out there that can help you achieve them. 1. Equity funds. Equity funds are a type of investment fund that pools money from many investors to purchase stocks. These funds are managed by professional money managers who attempt to generate returns by investing in companies they believe will succeed in the future. Equity funds can offer investors several benefits, including diversifying their portfolios and accessing professional management. They also come with some risks, including the potential for loss and the need for patience when waiting for returns. For these reasons, equity funds may not be suitable for everyone. However, for investors willing to take on a bit of risk, equity funds can offer the potential for high returns. 2. Growth funds. A growth fund is a mutual fund that invests in stocks of companies that are expected to experience above-average growth. These funds are often focused on small and medium-sized companies with high growth potential. Growth funds can be volatile, but they offer the potential for high returns. For this reason, they have often considered more aggressive investments than bonds or income funds. However, they can also provide diversification for a portfolio that is heavily weighted in stocks. In general, they are best suited for investors with a long-term horizon and a high tolerance for risk. 3. Value funds. A value fund is a type of investment fund that aims to identify companies that are trading at a discount to their intrinsic value. While there are many different approaches to value investing, all value funds share the same goal: to buy undervalued stocks by the market and hold them until they reach their full potential. Value funds can be a great way to build long-term wealth, as they offer the potential for both capital appreciation and income generation. However, value investing is not without risks, and value funds can often be volatile in the short term. As such, investors should only consider investing in a value fund if they have a long-term time horizon and are comfortable with short-term fluctuations in the value of their investment. 4. Blend funds. Trying to choose the right investment can be daunting, especially when there are so many options out there. One way to simplify the process is to invest in a blend fund. As the name suggests, these funds invest in a mix of different asset classes, providing exposure to various investments. This diversification can help reduce risk and improve returns over time. Additionally, blend funds are often managed by experienced professionals who have the expertise to select the best investments for the portfolio. This hands-off approach can make investing easier and more enjoyable for many people. So if you're looking for a hassle-free way to grow your money, a blend fund may be the right choice for you. 5. Small cap funds. When it comes to investing, there are many different options to choose from. One type of investment that you may not be familiar with is a small cap fund. As the name suggests, these funds invest in companies with small market capitalizations. While these companies may be less well known than their large cap counterparts, they can offer investors several advantages. First, small cap stocks tend to be more volatile than large cap stocks, providing the potential for greater returns. Additionally, small cap companies are often more nimble and adaptive than their larger counterparts, giving them an edge in today's rapidly changing economy. Finally, small cap stocks are often undervalued by the market, providing investors with the opportunity to buy shares at a discount. If you're looking for an investment with potential, a small cap fund may be worth considering. 6. Mid-cap funds. When it comes to investing, there are a lot of different options to choose from. One type of investment that you may come across is a mid-cap fund. Mid-cap funds are a type of mutual fund that invests in stocks of companies with medium market capitalization, or mid-cap. This means that the fund invests in companies that are larger than small-cap companies, but smaller than large-cap companies. While there are some risks associated with investing in mid-cap stocks, there can also be some potential rewards. Mid-cap stocks tend to be less volatile than small-cap stocks, but they can still offer growth potential. Additionally, mid-cap companies may be less affected by economic downturns than large-cap companies. As a result, mid-cap funds can be a good choice for investors who are looking for both stability and growth potential. 7. Large-cap funds. When it comes to investing, there are many different options to choose from. One type of investment you may come across is a large-cap fund. As the name suggests, these funds invest in large-cap stocks, which are defined as companies with a market capitalization over $10 billion. There are several different benefits to investing in large-cap stocks. First, they tend to be more stable than small-cap stocks, meaning they are less likely to experience sharp fluctuations in price. This makes them an ideal investment for those who are risk-averse. Additionally, large-cap stocks tend to pay out regular dividends, providing investors with a steady income stream. Finally, large-cap companies are usually well-established and have strong brand recognition, making them less likely to go out of business than small businesses. Given all these advantages, it's no wonder that large-cap funds are a popular choice among investors. 8. International funds. One type of investment that many people consider is a mutual fund. Mutual funds are essentially a pool of money that is managed by professionals and spread across a variety of different investments. This can provide investors with greater diversification and potentially higher returns than they could achieve on their own. International funds are mutual funds that specifically invest in foreign companies and markets. This can be a great way to get exposure to new and rapidly growing economies. However, it also comes with the risks associated with investing in unfamiliar territory. As such, international funds may not be suitable for everyone. Before making any decisions, it's important to do your research and understand the potential risks and rewards of each type of investment. 9. Sector funds. There are many different types of mutual funds available to investors, each with its advantages and disadvantages. One type of fund that has become increasingly popular in recent years is the sector fund. Sector funds invest in a specific sector of the economy, such as healthcare or technology. The advantage of sector funds is that they can provide investors with a way to target specific industries that they believe will be outperformers in the future. However, sector funds also come with some risks. Because they are focused on a specific sector, they can be more volatile than other types of mutual funds. Additionally, sector funds may underperform if the broader market declines. For these reasons, it's important to carefully research a sector fund before investing. 10. Fixed income funds. Fixed income funds can offer investors several benefits, including regular income, diversification, and the potential for capital appreciation. These funds invest in a variety of different types of bonds, which can offer different levels of risk and return. Like other types of mutual funds, they offer investors the opportunity to diversify their portfolios and to receive professional management. However, fixed income funds also have several unique characteristics that make them an attractive investment option for many people. For example, because bonds tend to be less volatile than stocks, fixed income funds can provide a measure of stability for an investment portfolio. In addition, fixed income funds often offer higher returns than money market or savings accounts, making them an excellent choice for investors who are seeking to grow their wealth over time. As with any investment, there are risks associated with investing in fixed income funds. However, for many investors, the potential rewards of these investments outweigh the risks. How to buy and sell mutual funds. The process is quite simple if you're considering investing in mutual funds. In most cases, you must contact the fund company directly and request a prospectus. This document will provide you with all the information you need to know about the fund, including the investment objective, fees, and performance history. 1. Buying. When you're ready to invest, you can write a check or transfer money from another account. Most fund companies will require a minimum initial investment, which is typically between $500 and $5,000. Once your investment is made, the fund company will use the money to purchase the underlying securities in the fund. In most cases, you will be able to start investing immediately. 2. Selling. The process is just as simple if you need to sell your mutual fund shares. Most fund companies allow investors to redeem their shares at any time, and the proceeds will be deposited into your account within a few days. There may be a fee for selling your shares, but it is usually quite small. The biggest risk when selling mutual funds is that you may have to sell your shares at a loss if the market value of the fund has declined since you purchased it. 3. Other considerations. When you buy or sell mutual fund shares, remember that you may be subject to taxes on your gains. In most cases, you will not have to pay taxes on your investment until you sell your shares. However, consulting with a tax advisor is crucial to ensure you understand the tax implications of investing in mutual funds. Picking the right mutual fund. With thousands of mutual funds to choose from, picking the right one can seem like a daunting task. However, you can do a few things to make the process easier. 1. Check the fund manager's tenure. When looking at mutual funds, it's vital to check the fund manager's tenure. The longer the manager has been with the fund, the better. Why? Because a fund manager who has been with the fund for a long time is more likely to have a good track record. And a good track record is important because it means the fund manager is experienced and knows what they are doing. So when you're picking a mutual fund, be sure to check the fund manager's tenure. 2. Consider the fund's asset allocation. When you're picking a mutual fund, it's critical to consider the fund's asset allocation. That's because asset allocation is what determines how the fund will be invested. For example, a fund with high allocation to stocks will be more volatile than a fund with low allocation to stocks. That means the value of the fund will go up and down more, but it also has the potential to provide higher returns over time. On the other hand, a fund with low allocation to stocks is less volatile, but it also has less growth potential. So if you're looking for stability, you might want to choose a fund with low allocation to stocks. But if you're looking for growth, you'll want to choose a fund with a high allocation to stocks. Either way, ensure you understand the asset allocation before investing in any mutual fund. 3. Read the prospectus. One important step in choosing the right mutual fund for your needs is to carefully read the fund's prospectus. This document provides an overview of the fund's investment strategy, fees, and historical performance. By taking the time to read the prospectus, you can gain a better understanding of how the fund operates and whether it is likely to meet your financial goals. In addition, the prospectus can help you compare different funds and choose the one that is best suited for your needs. So if you're planning to invest in mutual funds, be sure to read the prospectus before making any decisions. Mutual funds offer a simple and convenient way to invest in a wide variety of securities. By pooling money from many different investors, mutual funds provide access to a variety of investment opportunities that would not be available to individual investors. And because mutual funds are professionally managed, they offer investors the opportunity to achieve their financial goals without having to actively manage their investments. If you're considering investing in mutual funds, be sure to check the fund manager's tenure, consider the fund's asset allocation, and carefully look over the prospectus. These steps will help you choose the right mutual fund for your needs. And remember, if you're ever unsure about anything, be sure to consult with a financial advisor. They can help you understand the ins and outs of investing in mutual funds and make sure you're on the right track to achieving your financial goals. Afterword. Congratulations on making it through all 5 chapters of Master Your Investing. You should now have a much better understanding of how to invest in stocks, bonds, ETFs, index funds, and mutual funds. This informative guide covered all the basics of each type of investment, from what they are and how they work to their respective risks and rewards. The first chapter on stocks provided an overview of the different kinds of stocks and how they can be used to generate income or growth. We also discussed the risks associated with investing in stocks and the potential rewards. In Chapter 2, we covered bonds and how they can provide stability and income for investors. We also discussed the different types of bonds and the risks and rewards associated with each. Chapter 3 focused on ETFs, which are a type of investment that can offer diversification, flexibility, and cost efficiency. We also discussed the different types of ETFs and the risks and rewards associated with each one. Index funds were the focus of the 4th chapter. We discussed how these types of investments could offer diversification and professional management, as well as the risks and rewards associated with investing in them. Finally, in Chapter 5, we covered mutual funds. We discussed how these types of investments could offer diversification, professional management, and growth potential. We also discussed the risks and rewards associated with each. The goal of this guide was to provide you with a better understanding of how to invest in the different types of securities so that you can make more informed investment decisions. Remember, there's no one-size-fits-all approach to investing, and what works for one person may not work for another. It is vital to research and consult with a financial advisor to find the right investment strategy for you. Now that you know all of the basics, it's time to start putting your knowledge into practice. Happy investing!